You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
We're back. We are talking to Professor Terrance Odean, who is the Rudd Family Foundation Professor of Finance at the Haas School of Business at the University of California at Berkeley. He has his BA in Statistics from the University of California in Berkeley and a PhD in Finance, also from the University of California at Berkeley. I guess he likes California quite a bit. He's an Associate Editor at the Journal of Finance and the Journal of Behavioral Finance, a member of the Journal of Investment Consulting Editorial Advisory Board, and the Russell Sage Behavioral Economics Roundtable, a former director of UC Berkeley's Experimental Social Science Laboratory, and the former editor of the Review of Financial Studies. Terrance Odean also has worked with Professor Daniel Kahneman, who was, in fact, on this show, the Nobel Prize laureate in economics, although, interestingly, not an economist himself. Terrance Odean's research has been cited very broadly in the Wall Street Journal, the New York Times, Time, Newsweek, Businessweek, as well as in my own office at Profile Investments, where I regularly refer to the work that he's done, and I have to say I've probably done it since I'm in the business as a financial advisor, because he has spoken and published and discovered so much about human nature. So, Professor Odean, it is an honor to have you on the show.
Thanks, Doug. I'm happy to be here.
Listen, my first question is like this. Investors always seem to be at the tail end of a trend. They're chasing each other to invest in what seems like today's hot deal. We call that herding, right? That's the concept. They're literally like sheep. But why are people so prone to do this, and how can they stop themselves?
Well, I think, what's going on for a lot of people is they expect the recent past to repeat itself. So a lot of investors buy the stock they wish they had bought last year. They buy the mutual fund they wish they had bought last year. They hire the financial advisor they wish they had hired last year. And, there are areas of life where you do tend to see that sort of repetition. If you go to track meets, you'll see that the person who wins the 100-meter dash at one meet quite often wins it in the next meet, but that doesn't seem to be the way the stock market works. So I think that people are using this fairly simple heuristic of sort of trying to understand how the world works from what has happened recently, and they're projecting it into a space where it doesn't work very well.
It does seem logical. In other words, I've said this to people on many occasions, and they say, okay, Doug, so if I can't look at my only experience with the world is what I've lived. So if I can't use that to try to understand my world, what else is there out there?
Sure, but people who study the market are also using, their experience and the experience of others to study the world. And if you take a larger view, you see that this strategy of piling on to trends doesn't tend to work out that well, and particularly so for individual retail investors who tend to be late in the game. So they, a few years back, well, actually it's about a decade back now, a friend of mine who's a retired art school teacher in Toronto sold all of her Canadian mutual funds to buy U.S. high-tech stocks. This was at the end of 99 or early 2000, and she ended up losing about 80% of her investment. And she didn't tell me she was going to do this. She told me afterwards. I was thinking, she was a very unsophisticated investor. She was a very good artist, but a very unsophisticated investor. And she's likely to be the one. When she thinks that she knows what's going to happen, it's really too late. So the average investor is better off not trying to time the market. I've done a study with my colleagues Brad Barber and Jane Liu and Neil Lee, where we look at every trade made by every investor in Taiwan, institutional investors and individual investors. And we look at Taiwan because we get every trade for every investor from the exchange. So we see the full picture. And we wanted to see how much, trading was costing individual investors. What were their trading losses to institutions, their market timing losses, how much were they paying out in commissions and other trading costs. Well, first of all, they had poor market timing. When the individuals as a group were putting more money into the market, on average the market performed less well over the next 6 months. When they were coming out of the market and institutions were going in, on average the market did better over the next 6 months. So the individuals as a whole tended to get things wrong. Their picks were bad. On average, if the individual bought a stock from an institutional investor, that stock did poorly relative to the rest of the market. If they sold a stock to the institutional investor, on average it did well relative to the rest of the market. When we added up the market timing losses, the stock picking losses, the commissions that were being paid, and the other transactions costs that were being paid, individual investors as a group were losing an amount equivalent to about 2% of GDP through their trade activities.
That's huge.
Yeah, that's compared to if they had just taken a buy and a hold approach. They were coming up with, it was about a shortfall of about 3.8 percentage points a year in the average account.
That's amazing.
Now, they were very active traders, so I wouldn't suggest that your listeners are losing that much, and I'm sure your listeners are more sophisticated than the average investor. But in general, active trading hurts people. And Brad Barber and I did a study in the U.S. where we looked at 60,000 individual investors. We sorted them based on how actively they were trading, and the 20% who traded most actively, on average, underperformed the buy and hold investors by about 6 percentage points a year.
Wow, that's amazing. We are talking to Professor Terrance Odean, who is the Rudd Family Foundation Professor of Finance at the Haas School of Business at the University of California in Berkeley. He is very, very well known for all of his work in behavioral finance, which, as I describe to people, means why is it that people always do things that are bad for them, even when they know better. And he was telling us about a study in Taiwan, and then a study where they looked at tens of thousands of investor accounts in the U.S. So my question on that is, where do you get that information? Why would a brokerage firm supply you with all of that data when all it does is discourages people from trading, if it's one of those types of brokerage firms where they want people to trade?
Sure. That's a very, very reasonable question. It took me almost a year when I was a PhD student to finally get data from a brokerage firm. And I knocked on a lot of doors, made a lot of phone calls, wrote letters, asked people if they knew anyone who knew anyone who knew anyone in a brokerage firm. And finally I basically got lucky. I got lucky in the sense that if you keep trying, sometimes it works out against the odds. And I got a data set from this brokerage firm, and then I got a follow-up data set. So I first got data for 10,000 investors, and then I got a second data set for 78,000 investors. Then I wrote a bunch of papers with titles like Do Investors Trade Too Much? Trading is Hazardous to Your Wealth, a variety of things like that. I met the CEO of the company after publishing these papers at a conference and asked him if I could get a third data set. And his reply was, he was very polite, but he said, well, we have a lot of respect for your research, Professor Odean, but I just don't see what's in it for us.
so much for that.
Yeah. So yes, I guess at least that brokerage firm, if not others, came to the same conclusion that you did. I think. Yeah.
I was going to say, I remember when you came up with those studies, because I remember I used to tell clients, there's this professor at the University of California, he's looked at 10,000 accounts, which I thought was pretty neat at the time. And then later when you published about looking at, I think it was 66,000 was right, some other number, I said, that seemed like, that is statistically significant. My guess is you probably would have come up with very similar numbers if you looked at even just a few hundred, but it certainly makes the research that much more rigorous. And gives your grad students a lot more work to do if you
gives the computers more work to do. It's actually not that well. It's a little harder to deal with the bigger data sets, but it always takes longer. But as you say, it gives the studies a little more weight and validity.
Yeah, it's interesting what you were saying before about how the institutional investors tended to do better than the individual investors. What do you attribute that to?
I attribute it to a couple of things. One, there are times where institutional investors know things that the individuals don't know. So at times they have an informational advantage, or perhaps an ability to process publicly available information in a better way. Some institutional managers, make money, especially like, market makers, and that will make money by providing liquidity, being willing to trade with overly eager individuals who are sort of demanding liquidity. And we see that in Taiwan, that the individuals who trade most aggressively end up incurring significant losses, and so they basically end up paying too high of a price when they buy and getting too low of a price when they sell because they're in too much of a hurry. But I think that in a larger sense, that institutions are benefiting from mispricings that to a great extent are created by the individuals themselves, or more broadly, created by investors who have biased behavior.
Do you think the institutions suffer less from the biases that you talk about, media bias?
I do think they suffer less from them. It's not that they have no biases. Most institutional investors start out human, and they remain human, and they remain human, but they manage to shed some of the sort of intuitive mistakes that we make. They have institutional learning, and they have experiential learning. So you could think of it this way, that maybe all or most of us would unlearn, or learn to make better decisions, or unlearn some of our biases, given enough experience, and certainly given enough experience and a tendency to sort of keep records and go back and reflect on what's happened. But most individual investors aren't that systematic in their learning about investing.
I think they also don't have a board of directors. In other words, a lot of times in institutions, if a guy has an idea, he doesn't just push the button or pull the trigger. He's got to present it to a board, and it makes it less emotional. It's still emotional, but not.
And a lot of institutions, they put into place rules to deal with some of the mistakes that we're psychologically inclined to make. For example, I've done research that shows that investors tend to hold on to their losing investments and sell their winners. Mm-hmm. And actually, a lot of people have done additional studies on this. I did a study on it that was published in '98 with again, individuals at a discount brokerage firm. But people hold on to their losers, they sell their winners. For individual investors, this doesn't work out as an investment. The winners they sell tend to go on to outperform the losers they hang on to. It doesn't work out in terms of taxes in the U.S., where you can actually write off some of your losses. During the period I studied, people could have been writing off up to $3,000 of ordinary income, against their losses, and they could have offset capital gains with these losses. But so they're making the wrong decision from a tax perspective, and as it turns out, from an investment performance perspective. There are institutions where there'll be a rule, which along the lines of if a money manager buys something and it drops 10%, that he or she's required to sell. I mean, it varies with the institution and the type of. But I've had talked to traders who said, "Well, I couldn't do that if I wanted to. They don't let me do that." Because the institutions realize that people are going to become emotionally caught up in their trades in a way that might not be beneficial.
I hear. Listen, we're just about out of time, but we're talking now to Professor Terrance Odean at the University of California, who is very well known for his research on behavioral finance. He's cited regularly in the Wall Street Journal, the New York Times, Business Week, all over, and as I said, many times in my office as well, when I'm talking to clients, telling them that they seem to be suffering from some sort of behavioral finance problem. But I usually try to say a smooth way to say it. But one thing you've noted that I just want to maybe close with is men and women seem to be different in this when you look at the way they trade. Could you explain why that is?
Sure. So Brad Barber and I did this study some years ago. We were trying to test this hypothesis that overconfidence is one of the things that causes people to trade too much and earn lower returns. And what we would have ideally liked to have done is gotten a large sample of investors and, given them some sort of test to determine who is more overconfident, less overconfident. And our prediction would have been the more overconfident investors are going to trade more actively, and this trading is going to hurt their returns. Well, we couldn't administer psychological tests to thousands of investors, but we were able to use sort of a proxy for who might be more overconfident, which was, gender. It turns out that on average, men tend to be more overconfident than women, particularly in areas like finance, mathematical sciences. And so our prediction was, well, if this is the case, then we expect that men will trade more actively than women, and it's going to hurt their returns. And that's exactly what we found. We found that men traded 45% more actively than women, and when we separated it into just single men and single women so that we could get, away from, sort of spousal influences, single men traded 67% more actively than single women.
Unbelievable.
Then we took a look at returns, and basically we measured the effect of trading on an investor's return. So what we did is we took a look at investors' portfolio at the beginning of the year, figured out what that portfolio would have earned if the investor had just taken a buy and hold approach for the entire year. Then figured out, calculated what the portfolio actually earned, after all the trades and the commissions and everything that the investor made. We subtracted the buy and hold return from the actual return to get sort of a benchmark as to, to measure what the effect of trading was. And we found that both men and women tended to underperform a buy and hold approach to investing, but that men underperformed by 1 percentage point more a year than women, single men by 1.4 percentage points more a year than single women.
Wow. That is amazing. Truly amazing. All of the work you've been doing, Professor Terrance Odean from the University of California on behavioral finance. It is fascinating to talk to you, always fascinating to read your work. Where do you recommend is the best place for people just to follow up and read some of the papers you've been writing?
All of my papers are on my website, www.odean.org. Okay,
listen, thanks very much. I really appreciate the time.
Thanks, Doug. Bye-bye.
Take care.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.